The information discussed in this presentation is current as of the date noted, is for informational purposes only, and does not intend to address the financial objectives, situation, or specific need of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment tax or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality.
Good afternoon, everybody. Thank you again for coming in today. We are going to talk about why taxes matter in retirement. A lot of times when you're retiring, you want to plan for longevity, how long you need to make your money work for you, cash flow. We also have to consider market fluctuations and what effect does that have on your retirement income. But when it comes to taxes, we are in a unique situation with retirement because now you have control over your income and your tax situation. So we'll get into that and how that can affect your retirement income sustainability, the Social Security benefits and how that's taxed, Medicare premiums, and your estate and legacy planning. Wrong way. Okay, common sources of income would be Social Security, your 401k and IRAs, pension income, and other investment accounts, real estate income if you were to sell your home, and Roth IRA withdrawals.
Many of us probably don't like paying taxes, and if you are the type that likes paying taxes, that presentation is the next building over. This is for folks that don't like paying taxes and want to try to maybe save some of those. But in the event that we can't save them, it is important to understand that taxes, as Amber said, we get a little more control when we pay taxes. So taxes isn't always about avoidance, it is about timing, right? So you're going to hear about some of that as well. We get to choose when we pay taxes, and we're going to go through some of the basics that help us decide that. The first one we want to start with is there was some pretty major tax legislation that got signed into law last year. Now, if you're on one side of the table, you say, well, it was kind of boring. There wasn't anything really major about it. And there's some folks on the other side of the discussion that said this was major event. Okay, so why is that? Well, if you did that and said, what did this really change, if anything? Probably about 60%, someone did actually study this, about 60% of that tax law just kept in place or extended or made permanent. I'm going to come back to that, what was already in place. Okay, but there is some importance there, because what it did is that it said, hey, the tax rates that we were living by for a number of years were locked into place. Okay? Certain deductions, credits, and other planning opportunities were locked into place. Without that tax law, at the end of last year, we would have had higher tax rates. Okay, the highest tax rate would have been bumped up to close to 40%. We would have lost some deductions. We would have lost some credits. So there was some importance. Even if you felt like there wasn't a whole lot of change there, it was important because the change that would have been presented to us would have been actually to the negative. Okay, so it was a important piece of legislation. It does influence certain things. We're going to get into some of the changes as well, but it does influence, again, going back to, hey, how can I avoid taxes, but when do I pay them, right? And there are some planning opportunities relative to withdrawal strategies, Roth conversion timing, and different things like that, okay? So let's jump into, but there were some new things, okay? So let's jump into one of them, senior deduction. Now, if you remember, whether you like them or not, Trump ran on one of his tax topics was no tax on Social Security. Does everyone remember that? Okay, we didn't get that. What we got was a new senior deduction. Okay, senior deduction, which is income-based. Each taxpayer listed, if you meet the criteria, 65 and older, have certain income level or under, you get a $6,000 deduction. Okay, so married filing joint couple can get $12,000 of additional deduction over and above standard deduction or itemized deductions. Okay, so now this comes back to my previous comment of timing of taxes. Okay, question becomes, do we take that as a tax savings today, or do we utilize that perhaps recognize more income in retirement because now we can subtract more, right? About that. So we get all our income coming in minus deductions, we pay a tax, okay? So if we get a little more subtracted from our income, do we just take that as tax savings today, or do we utilize it to recognize more income to hopefully save taxes down the road? Now, this is not a permanent deduction, okay? This is temporary, coming back to permanent. If you've ever heard that word before in terms of, we made these tax laws permanent, you know, or this section of the tax code is now permanent. There's nothing permanent in the tax code, okay? Even if they say it, it's not true. All right. What else did we get? Well, living in New York State, we also pay a lot of state taxes, right? State income taxes, we pay real estate taxes and so on, okay? And if you remember several years ago, if you itemized your deductions, you were able to deduct pretty much all of the state income taxes and real estate taxes that you paid. There were limitations, but now we saw under Trump's first administration when he came in and he said, we're going to put a cap on that, okay? It took near unlimited deduction down to $10,000, okay? And they call this the SALT deduction, if you've heard that term before, SALT, state and local tax. That's what that stands for. So the previous cap being 10,000, what did we get with the tax law that was signed in July 1 of last year? We got an enhanced cap now of up to $40,000, okay? But it is income based, meaning if you're over a certain income level, that 40,000 starts to come down and you get down to $10,000, back to that cap, okay? So this will cover your property taxes and state income taxes. Again, this is subject to change. You'll hear me say that a few times today, okay? But that we have to play with for now, all right?
Okay, and like I mentioned earlier, the different types of income, each one is going to be taxed differently. So there's really 3 buckets that we think of when we think of income tax. Your tax deferred, tax-free, and then taxable. So tax deferred, this is the pay later option. This is when you have an IRA or a 401k on the traditional side or pre-tax side, where while you're working, you're taking that deduction on your taxes and you're not paying tax on the amount that you're putting in there. So the earnings, they're not taxable year to year. They just stay within that 401k or IRA. It's when you make that withdrawal that you have to pay tax on that. And if you cannot take that before 59 and a half without having an additional penalty as well. With these types of accounts, you also, at age 73 right now, this is also a moving target of age, you have the required minimum distribution. And that's at the point where the IRS says, well, you've been delaying paying tax on these contributions for so long. Now you have to withdraw and pay those taxes that you owe. Then we have tax-free, which nothing is really tax-free. This is more so the withdrawals will be tax-free. So you're paying the tax ahead of time before you make those contributions to the Roth IRA or Roth 401k. Gives you all tax-free growth on all of the earnings and the growth within the account. So you're putting it in after tax. The earnings and growth are just being compounded onto that balance. And when you take that money out, there's no tax, no penalty. And with the Roth, because you've already paid tax, there are no required minimum distributions. You can continue to leave that in that account as long as you would like to. And then we have taxable. This is really what we consider the flexible bucket. So this is not tied to work earnings in any way. These are all after-tax contributions, very much like an invested savings account in a brokerage account. With this type of account, there are long-term capital gains and qualified dividends, but those do get special tax treatment known as capital gains tax. Typically, that is going to be more favorable percentage compared to your standard income tax bracket. This is a good tool to use as a bridge to retirement. If you do have that early retirement and you can't yet withdraw from your retirement funds, this is that account that you can pull from to bridge your way to where you can take those funds penalty free.
Okay. Now, we've been talking a lot about taxes that we're going to continue to pay, let's talk about some things that in the tax code that, yes, you have to pay, but you also get to avoid paying, okay? So on the federal side, what retirees need to understand is that, yes, you are still going to pay income taxes. Goes back to what I said earlier. You get to choose on timing to some extent. But there are things that you do get to avoid on the federal side, right? So think of FICA and Medicare. We don't pay those anymore unless our retirement is defined as we're going to retire from our firm, or maybe work something that's not as stressful or not the same career, something else that we want to do. So if we have earned income still, as we earn income, meaning through W-2s, we will pay FICA and Medicare tax. If we start a business in retirement, you will pay FICA and Medicare tax through those. But on retirement income that Amber just went through, those buckets, you don't pay FICA and Medicare tax. So you're done paying those. And depending on your state, you will pay state income taxes still, right? But New York is actually fairly favorable from a retiree standpoint, okay? And we're going to talk a little bit more about that. And Pennsylvania is not too bad either, if you're from Pennsylvania or know people in Pennsylvania, but New York, for as bad a rap as it can get from an income tax standpoint while we're working as a retiree, it's not too bad. State pensions are tax-free. Social Security is tax-free. And as retirees, we get the first $20,000 of retirement income tax-free as well, up to $20,000. So there are some benefits there. Let's talk about the federal tax rates, because this is where the planning kind of really begins, is understanding how the tax rates work from the federal side, okay? So the federal tax system is what we call a marginal tax rate system, meaning as you move through the brackets, the first income is always going to be taxed at 10%. Chunk of income at 12%, 22, 24, 32, 35, 37. These are the tax rates that were set into place, locked into place with that tax law that was signed in July. Now, if you look at this chart, there's a couple of pain points in here. Okay, what do I mean by pain points? Well, this is where the planning begins. We want to decide when we're paying tax and how much we're paying on it. Okay, if we are in the 10 or 12% bracket, married filing joint, we can have up to about $100,000 of taxable income before we move to the next bracket. Okay, now what does that mean? Again, add up all your income, subtract your itemized deductions or your standard deduction, that equals your taxable income. Okay, it's after deductions, so you get to take deductions first. Then you figure your taxable income, it's your top rate. First 25,000 married filing joint is going to be taxed at 10, the next 75,000 taxed at 12. And then we reach our first pain point. Look at the jump in that rate. That is the biggest jump in the tax bracket, as you can see. Okay, but then the next one's not so bad. If you're in the 22% bracket, you have somewhere between 100 and 200,000 married filing joint taxable income. The next bracket up, you can add another 200,000 income, and it's only 2% more. Okay, so when we're doing planning around timing of income, if you're in the 12% bracket, we want to be very careful, because that next dollar of income, you're going to pay 10% more on it. Okay, but if you're in the 22, maybe we want to load up the 22 and maybe even the 24, because the next pain point in the bracket is above 24, and that's where you go from 24 to 32. Okay, so important to understand how it works. That first chunk of income is always taxed at the lowest, and then the next dollar is at the next rate. Okay, so with the planning that we can do around that, again, how do we calculate that taxable income? We also have to understand, are we itemizing or are we taking the standard deduction? Now, the standard deduction keeps getting added to a little bit every year. It increases with inflation. So for married filing joint this year, it's $32,200. Remember, we get this special adder for age 65 and older. We get another $6,000 per taxpayer on top of that. Okay, so we could have $44,000 of basically standard deduction coming at us if we qualify. And then, or we can itemize. Now, what's the question around itemizing deductions? That one of the reasons that many people are finding themselves falling out of itemized deductions is because that stand up so much under Trump's first administration. What he said was, I'm going to simplify people's tax returns. You'll be able to file it on a postcard or something like that, right? Which was, again, like them or hate them, I don't care who said it, that's the most ridiculous statement in the world. Who's going to print anything on a postcard? I don't even know if printers will handle that anymore, right? That's number one. Number two, the simplification did not take into account your state income taxes, okay? But you may not be able to itemize on your federal tax return, and you might be able to itemize on your New York State tax return, okay? New York State has a similar tax system as the federal system. There's a standard deduction and there's itemized deductions, okay? So we have clients where they say, well, I don't have to do the accounting anymore. I don't have to keep track of my charitable contributions, and I don't have to give you my mortgage interest and my real estate taxes because I don't itemize on the federal return. State standard deduction is $8,000 for individuals and $16,000 for married filing joint. So they may be over the $16,000 married filing joint, but under the $32,200 for federal. It didn't get much simpler. It only got more complicated. Okay, so there is planning relative to when do we take deductions even, right? Because if in some years we exceed the standard deduction and are able, those are years we may want to pile on more deductions if we can, and we're going to talk about that, or in years that we're just going to fall into the standard deduction, then we're going to make decisions in that way, okay? Now let's talk about another set of tax brackets. If you aren't just enamored with tax brackets, we're gonna help you out even more. There's another set of tax brackets if you have taxable investment accounts. Okay, so this would not apply to the buckets that Amber covered relative to IRAs, 401ks, Roth IRAs, Roth 401ks, 403bs. It doesn't apply to those things. Okay, this is, you opened a brokerage account, you bought NVIDIA 10 years ago, and you are a happy camper, but you want to sell. You want to pay tax, but you got to pay taxes on it, okay? What do we apply to that? Well, there's another set of tax brackets in the federal code called capital gains tax rates, okay? So anytime that you take a capital gain, you have to determine is it long-term or short-term, okay? If it's short-term, meaning you held it less than a year, then you're going to pay your ordinary tax rate. That's the first set of brackets. If you held it longer than a year, you're going to pay long-term tax rates, okay? Now, what the creators of all of this, if they were really thinking, they would have had some alignment between the other tax rates and these tax rates, but they didn't, okay? So how do you determine which gains tax rate you're in? Well, it's a whole set of other income bands. So we often tell people, listen, if you're in the 10 or 12% federal tax bracket, you'll pay 0% capital gains rate, okay? I'm going to leave off the 22 for a moment. If you're in the 24, 32, you'll pay 15%. If you're above that, you'll pay 20%. But the geniuses decided to overlap these tax rates and make our job more difficult. I guess you could call it job security, is that we've got to figure out there's some so that if you're in the 22% bracket, you may be in 0%, or you may be in the 15. We just got to add it all up and figure it out, okay? Here's one more for you. Your capital gains factor in to your total income to decide what tax bracket you are in on the ordinary tax rates, and then any part of that that is capital gains gets broken out and taxed at these rates, okay? So there is planning here. The point is there is planning here, right? And it all boils down to timing of income. What do I mean by that? If you have a large capital gain, this could be on a residence, a rental property, something in a taxable investment account, okay? If you are in a high tax bracket year, ordinarily, an ordinary income tax bracket, we may not want to take a long-term capital gain on an asset in that year. You may be paying more than you should. You could pay 0 normally, but you might be 15 or 20% that year, okay? So timing of taxes is important overall because it will determine even when you sell certain assets in your investment accounts and whatnot, okay?
So like Jason just mentioned, if you were to sell a home, there would be capital gains on that. The gains would be based on the difference between your sale price, purchase price plus improvements. So if you bought a home for $400,000, put $100,000 of work into it, and sold it for $1 million, $500,000 could be subject to capital gains. However, they do give us an out on that. For single filers, you get a $250,000 exemption. And for married filing joint, you would get a $500,000. So in my example, if you are a married, you would not pay gains on any of that. That would just be straight income to you. However, there is a caveat. You do have to own and live in that home for 2 of the last 5 years, claiming that as your primary residence. So oftentimes you may live here and you retire and you want to move somewhere else, usually somewhere warmer, or you just want to downsize. So you want to take into account, if you've been there for at least 2 of the last 5, then you would be able to take that exemption. What if you have 2 homes and you want to sell both of them as part of your retirement plan? You would want to make sure that you're timing that out. After you sell that primary one, make sure you live in the next home for at least 2 years as your primary residence, and that exemption starts over again. So that's a good benefit. Jason kind of got into this already, but the state taxes that we have, New York is progressive, very much like our federal tax brackets. They top out about 8%. And there are some exemptions, so it is slightly more favorable. Pennsylvania, they have a flat income rate of about 3%, and they do not tax retirement income as long as certain conditions are met, and that would include your IRA withdrawals, 401k, and your pension income, as well as Social Security. So it's definitely more favorable in Pennsylvania, but there are a lot of benefits for New York, especially if you have that New York state pension.
Okay, Social Security. So Social Security, we often get this question a lot. When should I claim Social Security? That is a little bit beyond the scope of this. We're really focused on the taxes around Social Security, okay? And claiming Social Security, the timing of that is very personal. Social Security, when it was started back in the 1940s, it came out and said, here is a retirement income stream that you'll pay into and you'll get back. And at that time, the intention was that it would never be taxed, okay? Like I said, nothing in the tax code is ever permanent, is it? Because now up to 85% is taxable on our federal return. We just said New York State, Pennsylvania, they don't tax Social Security. So even though the rules have changed around Social Security and the taxability, it's still a pretty favorable stream of retirement income to us, okay? Which should influence when we claim it, okay? Because we went through a lot of the base understanding of tax rates and so on. So if we are needing income stream and deciding when we take it, we might say, well, I know that it's not going to impact my New York State return, my Pennsylvania return. There's only like 7 states that tax Social Security, and I don't remember them off the top of my head. But we know only up to 85%, and how you get there is based on other income, okay? So it won't go right to 85%. It'll be based on the other income you have. It's kind of a circular formula. So the question becomes, when do I claim it if I'm really focused on my taxes? Okay, if I have a choice of I can take money out of an IRA, a 401k, and so on, which may be fully taxable on my federal return, or I can start Social Security and up to 85% of that benefit is taxable. And I know it's not taxable on my state return most of the time, okay? So Social Security is a pretty favorable stream of income. When it comes to required distribution, this before. So years and years ago, you may remember this because we get this question a lot. For a long, long time, required distributions from our 401ks and IRAs and so on, it was 70 and a half is when we had to start taking that, right? Again, nothing in the tax code is permanent. They've changed those ages a few times now. Okay, now it's 73 and it's going to be 75. All right, and it could change again even before we get there. Distributions apply only to the tax deferred accounts at this point in time. Okay, because like Amber said, you've deferred that income. We now want our tax. We're going to make some money out, and it's a formula. Okay, the formula works like this. You take the end of year value of that account, and then the IRS has created a table based on your age and said, take this percentage out every year, and that percentage will change on how old we are. The percentage gets bigger as we get older. And the theory is that we will reach a certain age and they want us pretty much taking the whole thing out at some point, okay? The first year is about 3.65% is the first year distribution, okay? And now we don't have to start that till age 73. So if you had $1 million IRA, you're talking about $40,000 is what you'd have to take a distribution on. So we know that's coming, okay? We know that's coming. And this is where we start to tie together strategy, okay? If we are under age 73, we don't have to take anything yet. But what we just learned about is we said, okay, we know what our tax rates are. We can figure out what our tax rate's going to be. We can decide when to take Social Security and how that'll influence our tax rates. And we have a new senior deduction that we can add to at least a standard deduction. Do we have to wait to 73? Because if we do, what will that required distribution be at that time? Remember, we hope that our accounts are going to continue to grow, right? And if they do grow, that percentage, that dollars equal to the 4% is going to continue to grow as well. So that is a fixed known variable, right? That we know that that's going to happen at some point. Don't know the dollar amount, but we can project that forward, right? We can calculate numbers and say, well, we think the required distribution is going to be this at 73. But if we have this standard deduction or a year where we've got higher deductions and we have a senior deduction, right? We have this new $6,000 per person. Maybe we take some money out now because we might be in a lower bracket now. Most people are thinking just keep delaying. And we think a little bit differently, right? We're trying to optimize, trying to decide when we pay the taxes. So if we can get some money out, let's say we're in the 12% bracket, and remember that bracket goes up to about 100 grand of taxable income for married filing joint. Let's say our taxable income is $75,000 after we take all the deductions off. What would be wrong with taking out $25,000 and maxing out the 12%? Because the potential could be is if we wait to 73, bumps us into the 22% bracket, we're paying an extra 10% on the money at that point in time. Okay. Now, do we have to take the money out and put it in our pocket? Not necessarily. We'll talk about that. There's other things that this influences as well. Okay, is our RMDs will influence the taxability of our Social Security, and it will influence Medicare premiums.
That's right. Premiums are directly related to what your income is. And there's a separate bracket for that, which is in your packet, which shows you the income limits for, it's called IRMAA, that lovely, lovely IRMAA, income related monthly adjusted amount. So this is also where strategy comes into play when you're looking at Medicare premiums. If you're going to have a large withdrawal, can you take that over 2 years, maybe take half in 1 year and half in the next, so that you into that next bracket for IRMAA. And that's where your Medicare Part B and D premiums increase with the more that you make. So this also, this is where you always want to take a look. You're always planning ahead when it comes to retirement income of what is affected this year by how much money I take. Roth conversions. This can have a huge impact, right? If you want to start doing Roth conversions, everybody's talking about them. But when you do a Roth conversion, you're withdrawing from that pre-tax account, claiming that as income, paying the tax, and then converting that into the Roth account so that future withdrawals are tax-free. So you want to be really careful about the timing of doing that and being aware of where your income level is and how could doing a Roth conversion affect other areas. Another reason people like to do this is because if we're doing it in the right timing, that can reduce your RMDs. So if your RMDs are going to be very high when you get to that age, doing a Roth conversion would be able to reduce that amount that you're forced to take out. And that's where you want to really think about optimizing the current bracket before you jump into that next one, which could be 10, 8% higher. Reason for Roth conversions would be to for your gifts to your beneficiaries for what they're inheriting. What kind of tax situation are you putting them into when they inherit your retirement accounts? And we'll touch on that a little bit more detail later on. So you want to take a look at how much is your account going to grow? What is your tax rate now? What could it be based on what your RMDs would be in the future? So it's really about optimizing and strategizing how to do this and when.
Okay, let's talk a little bit more about deductions and timing of deductions. Remember I said earlier that if we felt like we were going to be in a situation where we were going to be able to itemize deductions, we may want to load up more deductions that year, okay? And there's a few ways we can do that and potentially save ourselves some taxes. So one of the ways that we do that, we call it the lumpy deduction strategy, all right? Lumpy deduction strategy is this. Is if you have a year that you can load up your deductions and get over that standard deduction amount of $32,000, okay, you do that knowing that probably the next few years you'll just take the standard deduction. And if you ran that math over the next 3 to 5 years, you'll notice that you'll actually have higher total deductions because you've been able to get over the standard, okay, for that 1 year, fall back into the standard deduction level for the future years. One way to do that, or people like to do that, is using charity as a trigger point for deductions. Now, we don't have to give to charity and take it as an itemized deduction, okay? So let's cover that first. There is something in the tax code that was made permanent called the qualified charitable distribution, all right? What that means is that we, from a retirement account, an IRA, and we can give it directly to charity, okay? This is a good strategy. It does not help with the lumpy deduction strategy, though, okay? This strategy says, I'm having to take money. You can actually start this before 73, okay? You can actually start this at 70 and a half, but many retirees really dial in on it for their required distributions because you can take some of that money, give it directly to charity from the person managing your retirement account right to the charity, okay? And for that benefit, you don't have to claim that as income, whatever amount you do, but you also don't get to claim it as a deduction either, which is okay. If we're not claiming it as income, we're not going to take the deduction, all right? Now, how does that save us money? Well, what was the stream of income that I said is the taxability is dependent on other income? Does anyone remember? Social Security. Remember, it's up to 85% taxable, which is determined based on other income. Well, if we are charitably inclined, and we know we've got to take money out of our IRA, remember required distribution, and we, instead of putting that money in our pocket and then giving to charity, what if we just reduced our income by giving it from the IRA to charity, and then maybe our tax bracket, maybe we're reducing the taxability of Social Security, okay? So it is a deduction, even though you can't claim it as an itemized deduction, right? Okay. Any questions on that so far? So let's go right to the lumpy deduction strategy. So this would be the other way. I don't want to give it right from my IRA, or I'm not 70 and a half yet. So what can I do to utilize charity? Well, I can lump it into bigger chunks, okay? If I normally claim the standard deduction, but in 1 year, I find a way to give a bigger chunk to charity where I get over the standard deduction, Now I'm getting some extra benefit, and then the future years I can fall back into the standard deduction. But I don't want the charity to necessarily get all the money today, because they'll keep asking me for money every year after that, and they'll expect that I'm giving more. There is a to get your charitable contribution up front and then still give it to the charity over the next few years. And it's using something called a donor advised fund. Okay? These are all available at Vanguard, Fidelity, managed by major institutions. And what this is it's kind of in the title, donor advised fund. You are the donor, you're putting money in, and then you're to the fund. And you get to go in and say, okay, give $1,000 to the church, and give $1,000 to the school, and give $1,000 to the food bank, and so on. Okay? And it doesn't all have to happen in 1 year. There's no end date on this. You could put $10,000 in and spread it over 10 years, 20 years, whatever you want to do. Okay? In the meantime, it sits in a fund and it's invested. So it could grow depending on how you choose the investments. Okay? Benefit of this. The moment the money goes from you into this donor advised fund, you get your charitable contribution for that whole amount. Now, if you spread that amount, you go in and now you're the advisor and you say, give $1,000 here every year or something like that, you don't get another charitable deduction at that point. You only get it when you put the money in. Okay? So there is a way to take a much larger deduction and actually maybe benefit from this in 1 year. The money does leave your pocket, but you get the benefit of the deduction. Okay? Now, how do we get a double benefit from our charitable contributions, whether you itemize or not, whether you use donor advised funds? Okay? Well, we know the first benefit really is when we give the money to the charity, but there can be another benefit depending on what we give to the charity. Almost every charity these days, broker account or an account with a financial institution that can receive shares of stock or mutual funds or exchange traded funds. Okay? And therein lies another strategy. We were lucky enough to pick NVIDIA stock 10 years ago, and it's up 1,000%, 2,000%. We can actually donate shares of that stock to the charity or to our donor advised fund. And what's the benefit? Well, normally people think, well, I'll sell the stock and I'll give the cash. Well, if you sell the stock, you got to pay the capital gains tax, and that can move your tax brackets. Okay? If you give shares of stock, not only do you get the possible deduction for the value of the gift, but you avoid paying the capital gains tax. So there's your double benefit. Okay? And it also works with that donor advised fund. So now you can avoid capital gains tax. You can take several shares of stock or funds and dump it into this fund, avoid all that capital gains tax, and then spread that out over a number of years. And you've captured the tax deduction and you've avoided the capital gains tax. And you've managed your tax brackets, because if you sold the stock, remember, capital gains is a line item in calculating your total income to arrive at your taxable income, even though it's long-term capital gains are taxed at lower rates. Okay? Okay, inheriting retirement accounts. So this is kind of goes to what you were saying in terms of the Roth. Right?
Yes, that's right. And also it ties in with the charitable donations as well. So there are new rules when it comes to inheriting retirement accounts. At this point, if you inherit an IRA or 401k, the beneficiary has to withdraw that money within 10 years. So you can see where that could be a huge tax obligation for the who is inheriting that if they have to take that portion out every year over 10 years. And that only applies to non-spouse. So if you inherit it from your spouse, you can get that right into your IRA, and you can wait for your RMDs when you turn that age. You don't have the requirement of having to take that out. And so this applies to all retirement accounts, even Roths. However, that's a benefit to the beneficiary because they do have to take that over 10 years, but any tax on that. So again, large inherited accounts can create significant exposure if you're not planning for those carefully. And this is where you can think about leaving those tax-deferred accounts to a charity. So if you have a large 401k or IRA and you don't want your immediate family to have to pay those taxes, if you leave that to a charity, you're not paying tax on that, and either they can receive that as a donation. And then maybe you want to leave your after-tax money, your Roth IRAs and 401ks. Maybe you want to leave those to your kids and grandkids so that they don't have that big tax bill when they get those withdrawals. And investment accounts, those brokerage accounts, those are also nice to leave to beneficiaries because as soon as they inherit that, they get a step up in the basis, so there's no immediate capital gain. Whereas if you are living, you have that stock that's appreciated and you're paying that capital gains tax and then gifting it, you're the one taking the hit on those capital gains taxes. This is where just really planning of what do you have, where do you want it to go, and what's the most efficient. And do you want to pay the tax ahead for somebody else? Or do you want to take the withdrawals while you're living and leave so much?
Okay, so kind of going back and just covering a few of the things that we've talked about already. We've mentioned where taking large distributions from your retirement accounts can be detrimental, right? And so planning ahead, sometimes they're forced on us through RMDs. But if we can plan in advance, right, really plan our tax brackets effectively, it may make sense to take withdrawals out sooner, even though we're not programmed to think that way, right? We're usually programmed to think, let's delay the tax as long as we can. But this is the whole, one of our key points here is don't stay programmed, don't stay locked into that methodology. This is about, not always about avoiding taxes, but choosing when you pay them. And sometimes there are some years that are more effective than others. Waiting until requirements to start is not always the best thing, okay? Kind of this similar to the last point. And I'm going to share something else that I meant to say about required distributions. When you retire, we typically have our retirement plans with our employer, right? 403Bs, 401Ks. And we often have the choice of rolling those directly to an IRA. And sometimes that's beneficial and sometimes it's not. Why would it not be beneficial? Well, you can actually withdraw from a 401k at age 55 and not pay a penalty. Whereas if it's an IRA, it's 59 and a half. Okay, so there are benefits. What's one of the things related to required distributions? Well, let me paint a picture. Let's say you have two 401ks, one from an old employer and then you retired from another. And then let's be crazy about this, you have 20 IRAs, okay? So you have 22 different accounts. I don't know why you would, but let's just say that's at an extreme, okay? When you go to calculate your required distributions, you have to calculate the distribution from all 22 accounts. 401k, 403b rules, also known as qualified plans, you have to take a distribution from each of those accounts, okay? So you calculate it, you have to take it. But IRAs have something called an aggregation rule. The aggregation rule says if you have 20 of those things, still calculate what the required distribution is, but you can take it all out of one. You can spread it over all 20. You can take it from 5 of them and not the rest, okay? And so this could be one of the benefits. And the reason why this is a benefit here in terms of waiting for RMDs to plan is if you get to the year you turn 73 and you're just learning that now, you have no flexibility, right? Now you could the next year, you can kind of eliminate that whole mess and roll your 401ks into your IRAs and so on, okay? So there is benefits to not waiting until you start RMDs, not just because of the dollar amount and deciding when you pay taxes, but also the flexibility of where you take the money out of, okay? Coordinating with Social Security planning, like we talked about, where if you let the RMDs build, if you let the IRAs build and you don't do this tax planning in advance, you're taking Social Security, it could impact the overall taxability of Social Security. Amber mentioned IRMAA. This is a big question we get, right? And sometimes that's just part of life, okay? Sometimes we fall into that IRMAA trap. But understand how IRMAA works is that it's a 1-year issue, potentially, and it's usually 2 years in advance, right? 2 years after we've caused the issue, okay? Why is it 2 years? Well, because it takes that return to work through the system. So let's say in 2025, you breached the next IRMAA bracket. You won't feel the impact on your Medicare premiums until 2027, okay? Because it takes this long for the 2025 return to get through there, okay? So you have time before it actually impacts you on your premiums, but then just know, you want to know that in advance, because you don't want to wait until 2027 and go, oh, I'm paying more. I better fix it. Too late. You're probably already in it for the 26 return year as well, okay? And then the tax diversification opportunities. So Amber highlighted 3 buckets, the 3 simple buckets that we like to talk about: tax now, tax later, never taxed again. And it can be important to establish that diversification, even if it means paying some tax now to avoid paying any more taxes in the future, or like she said, relative to Roth conversions, the gift that you're giving to the next generation. I'm going to pay the tax for them now by moving monies from my tax-deferred account over to my Roth, and it's a way to give a gift without writing them a check today, but you've given them a tax-free asset that they'll never have to pay tax again in the future. And why could that be important? Well, think about the tax brackets, okay? If we're paying that tax at 12%, and the next inheritors of our retirement accounts may be bracket when they actually receive it. So we pay it at a lower bracket and give it to them so they can take it out, and it won't matter, right? They might be in the 22 or the 24% bracket. So when they're actually taking it out, it's coming out tax-free through those Roth conversions, okay? Okay, a couple more complex. What I will tell people is that anyone that has a 401k with company stock in it, and nowadays about Corning stock, because how well that stock price is doing. Sometimes we accumulate our company stock in our 401k, and most people write, these days when the stock's doing well, let's sell out of our 401k. And all I ask is that you pause before you do it. We will never say that taxes is the first decision. Okay, we have a common phrase. We say we don't let the tax tail wag the dog. Okay, the investment thesis has to come first. So if you have too much stock and a lot of it sits in your 401k, you should diversify. But before you do, talk to a tax advisor about net unrealized appreciation. What this means is that it allows you to separate Corning stock from your 401k or any company stock, allows you to separate the company stock from your 401k and pay lower tax on that overall, because you won't separate it out. You take that, okay, take it out of the retirement account system, you pay tax on your cost base of that stock, and it is all tracked by the administrator. It goes and sits in a brokerage account, and the difference between the basis and what it's worth now, that will all be taxed at long-term capital gains, which you get to choose when to recognize that gain, and therefore you get to choose your tax bracket that you're going to pay the tax on that gain. Okay, I'm going to leave it there because it is a strategy. If you have this situation or know someone who does, tell them to pause and talk to a tax advisor before they do anything. We often get the question of Roth 401k, pre-tax 401k. The general rule of thumb here is if you're in a situation where you're still contributing and you are in the highest tax bracket you'll ever be in before you retire, still put it into the pre-tax 401k generally, because you're saving, putting money aside at a high bracket to hopefully take it out at a lower bracket. There is a rule change here that now catch-up contributions, which most of us are in that situation where we're above the magical age of 50, where we get to add more to our contributions. Those catch-up contributions now have to go into a Roth. So guess what? We don't even have to make the choice with those. Those are just automatically going into the Roth for us. Okay? But what if we take a step back, retire from our first career, and we start a second career, or we start a business, or it's just some fun job that we want to have? Okay, should we still contribute to a retirement plan? Well, the same kind of general rule of thumbs apply. If the employer is matching, well, of course, they're giving you money. Put some money in there. But should I use pre-tax or should I use post-tax, right? Should I go Roth or should I go pre-tax? Comes back to tax rate. If you've taken a step back in your second career, you're in a lower tax bracket, and you haven't built up much Roth money, consider the Roth 401k, okay? Because now you're building that tax diversification. If you're still, let's say you have one spouse retired, took a job just to have some fun and make a little extra money and can contribute to a retirement plan, but the other spouse is still, going strong and working and full and in a higher bracket, make sure you're looking at both, right? Combining all the income to see where the best place for those monies might want to go.
So what do we want you to know? We want you to know that it's not just how much you're taking out of these accounts, but also where are you taking them from? And how does that affect your income tax bracket, your Medicare premiums, and your legacy planning? It's very important to have a comprehensive tax and financial strategy when we're looking at income in retirement and taxes, and what does that mean for your particular situation.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.